I love nature. I am passionate about social justice, and I worked in finance for 20 years. So I will tell you about cognitive dissonance. You see, finance boils down everything to three variables when you're making decisions. What is the return, what is the liquidity, and what is the risk of the investment you're making? With the understanding that the higher the return, the better, the lower the risk, the better, and the higher the liquidity, the better. Liquidity is how fast you can convert that into cash. That's all you need to know to make an investment decision. The problem is that when finance encounters a place like this, the outcome is often this, right? And you could say, what a waste. Whatever economic advantage was derived from this operation, it could not possibly have captured the true value of what we lost. Or you could say, what an injustice. Nature took thousands of years to build something like this. It's something that belongs to everybody and to future generations. But this common was privatized for the benefits of few people, right? But from a finance standpoint, if you bought this forest for $10 million and sold the lumber for $12 million, you would have gotten a 20% return. In fact, if you managed to do that transition in 6 months, you would have gotten a 40% return annualized. And in 3 months, an 80% return. Remember what I said, the higher the return, the better. And all you need to know is return, risk, and liquidity. And it was exactly this type of transformation that made me leave the finance industry. And I told the story last year, so I'll be very brief. But basically, I worked for a very ethically and professionally managed investment management firm. We had $20 billion under management in emerging markets equity. And our clients were endowments and foundations. And one of the best stock in our portfolio was a palm oil company that had destroyed tens of thousands of acres of rainforest. And that is when the cognitive dissonance between my personal values and what I was doing there with my job became too loud to ignore. And you know that Upton Sinclair said, it's very hard to make a man understand something if his salary depends on him not understanding it. But once you understand, you had to make a moral choice. And mine was to walk away from a very high-paid job. And since then, I've been looking at these large systems, money, banking, economics, and finance. How do they work? One thing that you need to know is that all investment capital originates through an accounting operation. Specifically, an expansion of the balance sheet of central banks around the world when they buy securities, usually government debt, and an expansion of the private banking sector when they make loans. So that's why right now there is an unprecedented level of debt outstanding, both public and private, around the world, while at the same time there is an unprecedented level of savings in the forms of investment capital scouring around the world for financial returns. And the two things are connected. And what I want to do, and this is the reality check and the big picture, and if I say something a little bit hard to take in, take a deep breath and let it out, because you need to know how things work. So first of all, it's an issue of scale. The GDP, world GDP a couple of years ago was $70 trillion. The liquid financial capital just in stock markets and bond markets around the world, $212 trillion, 300%. The GDP is called financial intensity. It has never been this high. And what about derivatives instruments? Have you heard about CDOs, credit default swaps, interest rate swaps? We issued about $1,200 trillion of those instruments a couple of years ago. And some of them, tranches of CDOs, ended up in money market mutual funds and caused the financial crisis of 2008. These numbers are not real. But I want to get a little bit more specific here and talk about possibly something that is in your portfolio. To do that, I need to do the terrifying carbon math. These are three numbers that are the most important numbers for us as a species. The first one is 2 degrees Celsius. You know what that means. We cannot warm the planet more than 2 degrees Celsius from pre-industrial levels. Why not? Because at that point, global ecosystems will start to unravel to the point where they can no longer support higher forms of life. That's us guys, right? So then we know we're warming up the planet by putting carbon into the atmosphere. How much carbon can we put in the atmosphere? 500 gigatons, a very large number, but at current emission patterns, will be there between 12 and 14 years. So it's not that far. But the most important question is, how much carbon do we have in the known reserves of the fossil fuel companies? And the answer is 2,800 gigatons. The human species has not wrapped its head around these three numbers. Because if we had, we would stop all deep ocean drilling for oil, we would stop all mountaintop removal for coal, and all extraction of tar oil sands. Because we have to leave 80% of all the carbon we know of in the ground. And here I'm tying it into possibly your portfolio. These are the 6 largest oil companies in the world. Their capitalization is in the hundreds of billions of dollars. The market is not getting this right. The market has not factored the fact that 80% of the carbon needs to remain unsold and in the ground. And when that happens, this market capitalizations will be in the tens of billions, not in the hundreds of billions. And if you look, and if you have a well-diversified portfolio, I'll guarantee you, you have these puppies in your portfolio. And they're not worth what the market thinks they're worth right now. One more piece of information. I know it's a little bit hard, but we're going to go through it. I mentioned about this huge pool of investment capital scouring around the world for investment returns. And there was a very important study that came out 2 years ago, sponsored by the UN. This is for a group called the Economics of Ecosystems and Biodiversity, and basically applied environmental economics principles to quantify the financial cost of goods that nature provides for free. I don't know if you notice, but nature has not charged us for soil, has not charged us for water, has not charged us for the wood in the forests, right? And so they looked at ecosystem services from land and from water. And they also looked at the cost of pollution, because nature actually tries to absorb some of our waste. And that's a service. And so the cost of greenhouse gas emission, air pollution, land and water pollution, and waste. And what the study did is a 15-year study that said, how much are the services worth? Services that we do not pay, but use. And they looked at something called region sectors. These are economic activity in a very large scale. So for example, coal power generation in Eastern Asia, or cattle ranching in Latin America. And I'm going to just zoom in one of this because I know they're pretty small. So cattle ranching and farming in South America used in 2009 $312 billion of unpriced natural capital to generate $16.6 billion worth of revenues, not profits, revenues, mostly selling meat to fast food companies. So, and if you look at the entire economic activity worldwide, we're talking about $7.3 trillion of unpriced natural capital that we've been using to generate the economic activity worldwide. What we're doing here, I don't know if you notice, we are treating nature as a business in liquidation, and we are subsidizing with its assets our economic activity and our financial returns. Most of the financial returns of that $212 trillion of capital that is looking for financial returns is subsidized by the natural capital. And so here we come to a little cartoon. You can imagine a couple of years out. Yes, the planet got destroyed, but for a beautiful moment in time, we created a lot of value for shareholders. I think we are right in this moment doing that, and we have to pay attention to it. And if you get one thing out of my talk, one thing is this. that the investments that we make today are not happening on a separate planet where only the financial returns are repatriated to us. The investments we are making today are shaping the world we are living in. And for that, I want to introduce you to this really cute creature called a tardigrade. How many of you know about a tardigrade? Yes, they're unbelievably resilient. They can be completely dried up for decades. And then you drop them in water, and after 15 minutes, they move again. And while they're dry, you can bombard them with 2,500 times the radiation that would kill us. And they've been found alive and quite happy at temperature between minus 50 degrees and plus 300 degrees Fahrenheit. Why am I saying this? Because if you happen to be a tardigrade, then your investment portfolio is creating the conditions in which you will have a very comfortable retirement. But if you are not a tardigrade, you really need to pay attention to what are your investments doing besides generating the financial returns for you. And of course, at a certain point, I realized I was not a tardigrade. And so the first thing I did when I realized that was to liquidate my entire portfolio. And when people say, oh, it's so hard to do that, no, it's super easy. It took me 5 minutes. Sell, sell, sell. Done. Now, the problem is, yeah, thank you. I've been called an angel divester. But you see, the problem is what you do now with this cash, right? And what I realized is that you see return, liquidity, and risk express two underlying psychological factors. One is greed, and the other one is fear. And I asked myself, what if my portfolio were built in a way that expressed different psychological motivations? What if I build a portfolio that expressed biophilia and empathy? Where return, liquidity, and risk considerations are secondary to that process. And I can report that now my portfolio expresses that, and I'll give you just a couple of examples. On the biophilia side, I invest in Farmland LP. You probably heard about them. They buy conventional land, convert it into organic, and the animals, pasturing on it are really happy. And the farmers and ranchers that are leasing the land are making a good life. Otherwise, this would not work. In between biophilia and empathy is the wonderful farm that Narendra has up in Oregon. Our Table Cooperative is a biodynamic farm, vertically integrated, multi-stakeholder cooperative. Everybody is involved and shares the profits of that operation. And finally, on the social justice side, the empathy side is People's Community Market. Brahma Madi is trying to build a full-service grocery in a food desert in West Oakland, mostly black, in the middle of plenty, because San Francisco area has the best restaurants, right? And so that's a sense for how my portfolio looks like, and I love it. I know exactly what my money is doing. And what I want you to understand is that after looking at the big systems, I came to the conclusion that the existential challenge for this generation, and most specifically for the people in that generation that has financial resources, is to finally take responsibility for our agency in the world expressed through our investments. And that we need to divest from the economic system and financial system that are pushing us towards a disaster, both socially and environmentally. And we talked about the challenges all day long and yesterday, right? They are connected to our investments. We need to mobilize not 1%, not 10%, but 100% of our financial resources to build the world we want to live in. So, I said I will be coming back to the personal, and the person of this time is you. So I want you to raise your hand if you are currently or are prepared to take responsibility for what your investments are doing out there in the world besides the financial return. Okay, look around you. I think what's happening, hopefully, is that this, the 5th National Conference of Slow Money, is the moment where the tide turns, when we are divesting from the suicide economy and investing in the economy we want to see. Thank you for being part of it.